Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to be joined today by Arleen Garza. Arleen, welcome to the show.
Hi, Whitney. Great to be with you again. Always a pleasure. And you're such a wealth of knowledge. So glad to be on your podcast with you.
Well, thank you. Thank you so much. And I'm so excited to learn from you here today. But before we dive into your portfolio that we're going to talk about here today, Oaks of Kingwood and Sunrise at Atascocita, 293 multifamily units in Houston, Texas. Tell us a little bit about yourself and where you're at in the multifamily space today.
Awesome. Well, I grew up in the far part of West Texas and then moved to Dallas, where I started a career in banking that lasted about 20 years. Within that, I was a lender. I managed banking centers, HR teams, and marketing teams. So the beauty of all of that is I was able to bring all of that knowledge and experience to our current business, which is a multifamily real estate firm based in San Antonio that I co-own with my husband. We also have a vertically integrated management company that we use to manage all of our 33 assets.
Well, again, Arleen, I'm excited to dive into your properties here today. Oaks of Kingwood, Sunrise at Atascocita, 293 units in Houston, Texas. So let's talk about, when did you close on the properties and what were the purchase price? Because I know you portfolioed this all together. And then
Yes. So we closed Oaks of Kingwood 2.5 weeks ago. And then we closed Sunrise at Atascocita on Monday. So just recently closed those. I'm looking at my numbers here. Oaks we bought for $15,785,000, and Sunrise was, give me a minute, $14,250,000. So great.
Just about 30 million there, right?
30 million, yeah. So and I think we've talked about portfolios before on your show. It's rare that you find two that are ready to go by the, at the same time, close to the same time frame, which gives investors an opportunity to invest once and own two assets. And so our investors love it. We like it. It's a little really, crazy there at the end because you've got two lenders, two title companies, two sellers, two brokers, all of it going on at one time. But we have a great team, and so we get it done. And then the management company usually is ready. We call it the day one difference to take over the properties because we've been meeting for weeks and weeks before. And the day we show up, the signs are going up, the marketing brochures are done, the employees have been hired, their uniforms have been delivered, and we're ready to start our renovation process, which usually that day there are vendors on the property starting power washing and painting and landscaping and you name it. So,
well, let's start from the very beginning. Okay. You
okay.
bought these properties really recently. When did you discover the properties?
We've been working on these since June. So quite a bit of time has been invested in these. They were owned by long-term owners, so 30 years and 20 years, which is odd to find now. So you can imagine, and I wonder, what did they pay for them 30 years and 20 years ago? But really irrelevant. They both were able to sell them at a really great price, but at a discount for us, right? We're buying them at 2018 and 2019 pricing. So it's a win-win, right? They get a good retirement money. They're both older gentlemen that sold the properties. So they get good retirement funds, and we get to buy two properties at a great price. What is interesting about these, not only that they've had long-term ownership, but 100% of the units are in classic condition. Now, that sends lots of visual messages to you, but really what typically you find when we buy properties is that 30, 40, 50% of the units have already been renovated. And maybe there's 50% that are still in classic white appliance, that sort of a thing condition. In this case, 100% of them were in classic condition. Now, the owners, because they've owned the property so long and they really cared for them well, new HVAC units, the properties are in great shape. They just have not modernized them. And so that is the value that we can bring to these properties, is to come in with a renovation plan that will modernize just the exterior and the interior of the units, therefore leading us to higher rents, higher income, and creating more value for these properties when we go to sell in the future.
Perfect. Okay, so we understand the overarching business plan, but let's get down to brass tacks about the
Yep.
mechanics here.
Yeah.
So, you started working on these properties in June. Was it through a broker or, was there competition to get them under contract?
There was competition. We had different brokers come to us after they found out we got the properties, because the owners had kind of interviewed a bunch of different brokers, and in the end, we worked with the brokers that ended up winning the deals. And they said, man, there was so many people that were vying for these properties. One broker said they had a buyer that said, I would have paid more. But because of the fact that these were all brokers that we have a long-term relationship with, they knew us, they knew that we would close on these properties, they knew that they didn't have to worry about us raising the money. We have a strong investor base, and so they awarded them to us, and they're 15 minutes apart. So for us, there's so many economies of scale and things that made so much sense that we decided to go for both of them.
Awesome. So when did you walk the properties? Did you walk the properties prior to putting in an LOI?
We tour them. We always tour the properties before we put an LOI, because you want to make sure that physically there's not something that would change your purchase price or your offer price. So we always tour them, and it's our team, right? Our acquisitions team does that. And then the LOI is submitted, and then at some point I am walking the property, and then at some point our whole team is doing the inspection of the property. So it is a process, but in the beginning, it's our team always tour. We have never offered on a property that we did not tour.
So tell us how you structured the contract in order to beat out the competition.
Well, in today's market, you don't always have hard money. And so in our case, just meaning money that immediately is non-refundable, right? So in this case, we asked for that non-refundability to happen after the inspection, right? In previous years, money would go hard immediately, and then more money would go hard after the inspection. But in this case, we tied it to the inspection period. It's part of the market, right? You don't have to give up so much, because it is a market where there's not a lot of sales going on.
Okay. So the earnest money, it didn't go hard, but let's talk specifics. Like, how much did you put down? Like, how much time did you have for due diligence to close on the property, different contingencies? If you exercised any extensions, did you have more hard money that went down?
Okay, very good question. So we did have a 30-day period, which is our typical inspection period, and then the first tranche of money went down. We typically are offering 1% or so of earnest of the purchase price is what we're typically offering. We did a little bit more than that in this case, because the broker said, look, these are long-term owners. They don't want to have to go back to market if this deal falls through. So we did a little bit more than the 1%, but part of it went hard. Roughly half of it went hard after the inspection period. And then we did offer additional dollars when we did extensions. So we had two 30-day extensions built in. In today's market, you never know, right? And so we wanted to have that extra insurance. And so additional dollars were sent in and then went hard after those 2 periods of time.
All right. So how did due diligence go?
It went well, actually. Our teams, our in-house management teams, are the ones that come. We bring in roofing contractors, foundation contractors, a plumber to, scope, put a camera down the lines to make sure there's no issues with the plumbing. Of course, looking at age of the air conditioning systems, looking at the appliances, everything in the unit, because really what we're doing is we're building our rehab budget at the inspection point, right? As soon as those vendors leave, they leave giving us a budget on what they're going to, submit for us to do the different repairs. And so just helps finalize our rehab budget while we're there. Didn't find any surprises. You never know. Sometimes you can go into properties and you might have a hoarder or two, or you might have some units that have been lived in for 25 years, and therefore you're going to have to spend more money to renovate those units. But didn't really find a lot of things that concerned us. And we always build in a little extra, even after the fact, into our rehab budget for just contingency items that might happen.
All right, so it doesn't sound like any surprises on the physical side of things. What about on the
No.
financial due diligence? Any surprises there?
Well, the one property, Oaks, had been 98% occupied for the last 5 years. Sunrise has been 95% occupied on average for the last 3 years. So we knew there was a lot of stability. We did find a lot of longer term residents, which can be good and can be a challenge, because we know we're going to go in, renovate, and raise the rents. And so we did take a look at that. We look at how the income that these individuals make. We look at the leases, every single lease, and we build a big spreadsheet. And we look at, can their income support a $50, $100, $200 rent increase? So what we determine is, will we have to bring in new tenants, or can these tenants stay and still afford the rents? The average most people look at is they want to see that a resident's income is 3 times the rent amount. And so we look at that. And in this case, both of the properties had income levels 4x or more than the rents, even the pro forma rents. So we felt really good that these residents were longer term, stable, and they had good incomes to help support the property.
All right, so everything was above board, it sounds like, on the financial side of things. Now,
It was, yeah. The one area that I wanted to spend some time talking about was the loan. In
yes,
today's
yeah.
market,
Well,
yeah,
let's pause for a second, because I got one more due diligence question
sure.
before, to help our listeners out. Given that these properties were classic condition and it had been a single owner for so long, did you run into any issues when you went to go get insurance? Like, I'm thinking, if units are in classic condition, maybe we've got some galvanized piping, like on property, like, older electrical panels. Like, did you have any issues with the insurance, either from like a deferred maintenance standpoint, or just from like the market conditions today?
No, that's an interesting question. So Oaks, the initial part of the property was built in 1984. They added a second phase in 1999. And so really we were looking at half of the property being a little bit older and the other half being a lot newer. And so we approached them by looking at them in different ways, right? What did they put into the new phase that wasn't into the older phase, and how did that impact the rents they're getting? And so that part of it was interesting to look at, but there really wasn't anything that we're like, oh my gosh, we ran into, stab lock electrical panels. That didn't exist. The pipes were in great shape. They were PVC or they were copper, which is what you want to see. So every time we turned around, we kept checking off another thing that was like, okay, that is great. That looks good for us. So really just didn't, which we were expecting to. I will just say we were expecting to, because they had longer term ownership. We thought, well, how much money did they really invest to keep the property going? But what we found is The HVAC units were in great shape, which sometimes you don't find that. The other thing that we liked, which was a big benefit, is each unit has a washer and dryer in the unit. Um, for 80s properties, sometimes you'll find that there are connections in some of the units, usually 2 bedrooms, 3 bedrooms, but you usually don't find the connections in 1 bedroom units with the older properties. In this case, every single unit type had actual washers and dryers in there, not just the connections. So that was another good benefit for us. And we also found when we were looking that neither owner was charging for things like pest control or trash, the normal fees that every other competitor in the area was doing. So automatically it was, wow, that's fee income right off the bat once these leases renew, because you can't charge it to them right away. It's as the lease renews, that you can start adding those fees. But every other competitor in the area is charging those fees. So it's not like we're going to be out of market adding those fees. We're actually going to bring the properties up to what the market standards were.
Good, good. And well, thank you for going into that.
Yeah.
Yes, let's transition to the lending piece. Tell us about the loan and all the details. Is it a public loan, private loan, interest rate, prepayment penalties, lockout periods, and just if there's any backstory here that we should know about.
Awesome, awesome. Well, we ended up deciding that we were going to do Fannie Mae fixed rate loans for both of these. And it was helpful to us that we had 2 loans to bring to one lender, right? Because they're getting more business. And so we really toyed with, do we do a 7-year term or do we do a 5-year term? A lot of it is looking at what does your exit strategy look like? So we decided to do 5 years because we believe, as everyone thinks, rates are coming down. So the environment will be very different, more competition, more buyers will come back into the market. And so we wanted a shorter window of time. Now, that doesn't mean we couldn't turn around and refinance these and hold them longer, but the initial loan term was 5 years. The one thing with it being fixed rate is we were watching any story about interest rates like crazy, so any little article that came out about the Fed and what they were planning to do with rates, or, even the jobs report and all the reports that the Fed was looking at, we were looking at the same thing to try to look at when's the right time to lock in the interest rate, because you can lock it in before closing. But you have to go through a process, right? All the third-party inspections by the lender needed to be done in advance. So we did those right off the bat, paid for those. Jacob and I are usually upfront all those costs. So we paid for those third-party reports. We made sure the lender was good with, their inspection. They had to go to the property and physically put their eyes on the property. And so, that puts us all in line. The underwriting needs to be pretty much signed off on, where they feel like, okay, we're comfortable with the income, we're comfortable with your pro forma analysis. And so once they give you the sign off, they say, okay, you can rate lock, you can lock that interest rate now. And so for the first one, Oaks was the first one that locked. And so the interest rates had dropped. Treasuries, these are all priced on the US Treasury bill. On, in this case, 5-year, because that's the term we were getting, is a 5-year term loan. So when rates dipped the first time, we locked in Oaks at a 5.2 rate. We didn't buy down. You can pay more and buy down the interest rate, but it wasn't going to help us in terms of the loan proceeds we would get. They all work together. So we decided, okay, no, we're just going to go with that rate. It's lower than we underwrote. We underwrote 5.8. So we knew that the returns we had shown our investors were going to be better just by locking in that interest rate at a lower amount. So then we came to Sunrise. Well, the week before sunrise, we were going to get everything ready to lock. Hurricane Beryl came through Houston. So the lenders said, we're not gonna, we can't get over there to do our inspection. The owner said, let's make sure we can assess it. We had no damage. And so it delayed us by a week, which at first we were so bummed. We were like, oh man, we were ready, right? We're ready to lock that rate. But then rates dropped that week, that the week after the hurricane. So, oh, the lender finally said, okay, the property's fine. We sent somebody out. We went out, made sure there was no damage. And so we were able to lock. We were actually in Florida on vacation with the family, and our team was calling and saying, okay, rates dropped again. It's time to lock it. So we locked that one at 5.04. And again, we were like, Hurricane Beryl didn't do a ton of damage, but we were like, thank you for the delay, because it allowed us to lock in a lower interest rate. And so that was very helpful to the loan overall. So I think because of that, we got about 500,000 in additional loan proceeds for each property by locking the interest rate, and because the properties continued to perform well. So every month we were getting a new rent roll, we were getting a new property financial statement, and we'd review it, send it to the lender. And as they kept continuing to improve on their performance, the lender said, okay, we can give you more loan proceeds because the property's doing well and you locked in a lower interest rate.
Well, that's good to hear. And yeah, I'm glad the properties fared well during Hurricane Beryl.
Yeah.
Well, did you raise money? You mentioned you had investors, so it sounds like you did raise money for these deals. Let's talk about that. How did you structure the deal for your investors?
So we have three classes of investors. We have A, B, and C categories, and they're based on the minimum investment level for each one of them. So Class A is at 75,000 minimum. Class B is at a 200,000 minimum, and then Class C, it is at $1 million minimum. Now, for each of these, the splits between the limited partners, the investors, and us, the general partners, is different. So for the $75,000 investor, 75% of the profits from the sale and proceeds goes to the limited partners, and then 25% to the general partners. Okay. And then the Class B investors, the 200,000 minimum, it's an 80-20 split. So 80% goes to the limited partners and 20% goes to the general partners. For the $1 million investment, that one is an 85-15. So 85% goes to the limited partners, 15% goes to the general partners. So the whole idea is a bigger investment gets you, a bigger split in terms of the returns. And so they get averaged out really by the time it all happens. But each of the groups receives distributions in pari passu. Just means if there's $150,000 to be distributed, assuming 33% is in each category, right? Class A has 33% of the money, B 33, and C 33, then it would be, each of the individual groups would get their share of it, and everybody participates in a distribution at the same time. Now, the other thing we added to this investment was a 7% preferred return. In today's market, investors are being very selective on what they invest in and who they invest with. And so for us, we wanted to let them know how important they are to us. So we said, your preferred return means you get your 7% before we get anything. So it, will be an incentive for us to even work harder for you so that you get your 7% on the front end before we get a return. So.
Well, let's talk about one other thing here that's in the waterfall structure, in the deal structure, I should say, and that are fees. So how did you structure your fees for this deal? And, like acquisition, since it's a value add, construction, and everything else?
Sure. So we have a 2% acquisition fee. We have a 1.5% asset management fee because we're, negotiating insurance, negotiating the tax protest, all of that happens along the way. And then we have a construction management fee of 10%. Now, we're going to pay that to whoever's doing it. It just so happens that it's in-house. We have our own team that does everything except roofs and painting the exterior buildings. We don't do those in-house. We don't have the equipment. We don't have the ability to, and the team to really do big scale projects like that. But then everything else we do is in-house. We don't have a disposition fee. So when we go to sell, there's no fee to investors. So, and we disclose all of that in our pro forma and all the numbers. And then the returns are net of anything we get.
Well, thank you for sharing. Uh,
Yeah.
as we wrap up here today, I've got two questions for you, Arleen. And that is, what did you find easy during this process that you thought would be harder? And then let's flip that on its head. What ended up being harder that, quite honestly, you thought would be easier?
Well, I'll start with the hard one first. I think for the first time, we had more questions from the lender than ever. Not necessarily, well, some about the properties because they were getting the same reporting. They were watching how much delinquency there was. All of that what became more important to the lender because we are in a slower economy. So they're watching every bit of that. They asked a ton more questions than we had ever gotten, which is fine. We know how to answer those questions. We get the data from the property, et cetera. And so I think that was probably the most different, I don't know if I'd call it harder, but most different piece there was to this transaction. I think on the easier side, it was the inspections and the results from the inspections. When you have longer term owners, you don't know what you're going to find. When you go unit by unit, looking at pipes, looking at foundations, looking at everything, you just think, oh my gosh, what am I going to find? But that went very smoothly.
Well, that's great to hear.
Yeah.
Arleen, thank you so much for being on the show today and sharing your time with us. If people want to learn more about you, how can they do so?
They can reach out to me at invest@reapequity.com, and that's REEP equity.com. You can go on that site and click a button, and it will ask for your contact information so that I can give you a call back.
Awesome. Well, again, Arleen, thank you so much for your time, knowledge, and expertise. We look forward to hearing about your future deals.
Sounds great. Thank you, Whitney, for having me on.